There's a reason the most financially stable businesses you know almost always have a line of credit sitting open that they rarely use. It's not because they need the money. It's because they understand something about timing that most business owners learn the hard way. Let me explain what a line of credit actually is, and then I'll show you exactly how it works with real numbers. Because once you see the mechanics, you'll understand why it exists at all. A business line of credit is a pre-approved amount of money your business can borrow from, whenever it wants, up to a set limit. The bank approves you once for a maximum, say $50,000, and then that money sits there, available. You don't have to take it, you don't pay for it while it's sitting there unused, but the moment you need it, it's there. Same day, no new application. Here's the mental model I want you to hold on to. Think of it as a reservoir, not a delivery. A loan is a delivery. The bank hands you a truckload of money on day one, you sign for all of it, and you start paying interest on all of it immediately, whether you needed all of it or not. A line of credit is a reservoir. The bank fills it and hands you the tap. You draw only what you need when you need it, and you're only charged for what actually comes out of the tap. Refill it, and the full amount is available again. That single difference, paying for what you draw instead of what you were given, is the entire reason lines of credit exist. That refilling is what makes it revolving. Draw it down, pay it back, and the available amount returns to full. It's a tool you use over and over, not a one-time event. Now let me show you the numbers, because this is where it actually clicks. Say your bank approves you for a $50,000 line of credit. Right now, you've drawn nothing. Your available credit is $50,000. Your balance is zero. And here's the important part. Your cost so far is also zero. An open, unused line of credit generally costs you nothing but a possible small annual fee. Now, a real situation. A large customer order comes in, and you need $20,000 of inventory to fulfill it. That customer will pay you, but not for 60 days. Your profit on the deal is solid. Your problem is purely timing. The money goes out now and comes back in 2 months. So you draw $20,000 from your line. Now your balance is $20,000, your remaining available credit is $30,000, and you're paying interest, but only on the $20,000 you actually drew. The other $30,000 is still sitting there, still costing you nothing. 60 days later, your customer pays. You use that money to pay back the $20,000. Your balance returns to zero, your available credit goes back to the full $50,000, and the total cost of solving that problem was roughly 2 months of interest on $20,000. Not on 50, on 20, and only for the 60 days you actually needed it. That's the whole tool. You just watched it work. And notice what it actually solved. It didn't make the business more profitable. The deal was already profitable. What it solved was the gap between money going out and money coming in, the exact gap that causes profitable businesses to run out of cash. A line of credit is a timing instrument, not a profit instrument. That distinction is the thing most people miss. Which brings me to the mistake, and it's the one that turns a genuinely good tool into an expensive problem. A line of credit is designed for temporary gaps that close. Inventory ahead of a sale. Payroll before a receivable lands. A short bridge with a clear end. The mistake is using it to cover an ongoing shortfall, drawing on it every month to make up for a business that simply isn't generating enough cash. When the balance never returns to zero, a revolving line quietly becomes permanent debt at a variable interest rate, which is a genuinely bad place to be. The healthiest sign in a line of credit isn't a high limit, it's a balance that keeps returning to zero. One more thing worth knowing: how banks decide to give you one. This will sound familiar if you've watched the lending videos. They're asking whether your cash flow can comfortably handle repayment. They're looking at your time in business, your credit, and your financials. A line of credit is generally easier to get than a large term loan, but it's still underwritten. And most rates are variable, meaning your cost can change over time. So here's what I want you to take from this. The businesses that stay steady aren't the ones that never face a timing gap. Everyone faces timing gaps. They're the ones who arranged access to money before they needed it, so a gap became a phone call instead of a crisis. That's the real lesson in this tool. The best time to open a line of credit is when your financials look strong and you don't need it, because that's exactly when a bank wants to give you one. Understanding that timing and acting on it early is what separates a business that gets caught by a cash gap from one that simply steps over it.